Welcome back. I'm Ian Masters, and this is Background Briefing, available 24/7 at backgroundbriefing.org. And joining us now, Robert Hockett, who has had first-hand experience working at the International Monetary Fund and the Federal Reserve Bank of New York, and continues to consult for a number of U.S. federal, state, and local legislators and regulators. He drafted Representative Alexandria Ocasio-Cortez's Green New Deal resolution for the House of Representatives and officially advises her on economic policy, and is the Edward Cornell Professor of Law and a Professor of Public Policy at Cornell University. His latest books are Money from Nothing, or Why We Should Stop Worrying About Debt and Learn to Love the Federal Reserve, Financing the Green New Deal, A Plan of Action and Renewal, and The Citizen's Ledger, Digitizing Our Money, Democratizing Our Finance. And he has an article at Forbes, What Then to Do Going Forward? How do we keep banks like SVB rather than handing them over to the Wall Street Big Five, while also avoiding debacles like that of last week? Welcome to Background Briefing, Robert Hockett.
Thanks, Ian. Really great to be with you again.
Well, thanks for joining us. And what I'm sort of reading in the press now about the collapse of the Silicon Valley Bank, which was one of the main sources of venture capital funds for startups in the Silicon Valley, and given how important the Silicon Valley is to American innovation, that in itself is alarming. But it seems that you can point the finger at two people, Jerome Powell for raising interest rates unnecessarily, and Donald Trump for gutting the Dodd-Frank regulations for smaller banks, requiring them to have stress tests and have more money on deposit. So am I right at pointing the finger in those directions?
I think you're right to do so. I think there are a couple of additional fingers that we can add, but it's also worth noting maybe that Powell, of course, was a Trump appointee. But I do think that they are two of the principal culprits. Another possible culprit or group of culprits were the short sellers, right, who are always out there ready to kind of short sell bank stock in order essentially to crash them after they've effectively sort of bet on the bank failures. And there's some evidence, it's not clear yet, but there's some evidence that some of that might have been going on here as well. But in essence, what we've got here is a story of a bank that in many ways did everything right. Not in every way, of course, but in many ways, they sort of have been doing what we kind of were calling for banks to do after 2008. And that is, of course, to become boring again. And by boring, I mean two things, right? First of all, actually making loans in the real economy, the primary markets where things are actually made, rather than in the secondary financial markets and the tertiary derivatives markets. And it is not without significance, it seems to me, that the entire loan book of SVB, that's to say all the loans that were made to startup companies, tech companies, and the like, were all performing. There's no suggestion that there was any trouble with those loans or that there were any delinquencies or what have you. In stark contrast, of course, to the loans that were on the books in 2008. And secondly, any surplus beyond that was invested in U.S. Treasury securities, which are, of course, what the Fed is itself invested in under QE, and which, of course, receive a zero risk weighting under all the capital regulatory regimes that we've ever had. And so, in that sense, this was a boring bank. It was doing what we want banks to do. The one exception to that we know of at the moment, well, maybe two exceptions, but the main exception is they don't appear to have done any very smart hedging against interest rate risk, which is usually something that you do. But sort of in their defense, Powell has raised rates at a rate that we haven't seen for over 45 years, not since the late 70s during the Paul Volcker period. 450 basis points in less than a year is kind of jaw-dropping. And so in some ways, it's kind of borderline force majeure, right? Borderline act of God or act of Fed. So that maybe they should have hedged against that, but it's worth noting that the Fed has actually lost immensely on its own portfolio because it's invested in the same things. The only difference, of course, is that the Fed can't fail. The Fed isn't a business and isn't subject to a profit imperative like SVB was. The second partial sort of quasi mistake here, but I feel much more sort of hesitant about this one, is that lots of the firms that were saving in SVB, of course, had accounts in excess of the FDIC $250,000 cap. In their defense, however, these are big industrial companies, and these industrial companies have big operating expenses. on a daily basis, not the least of them huge payrolls that they have to make. And so against that backdrop, a $250,000 transaction account is just chump change. It's peanuts. And so what we really need to do, as I've written in these two Forbes articles that you kindly noted, is update the federal deposit insurance system in a way that we began to do in 2005 but didn't finish. So in 2005, what we did is we introduced risk pricing to the premiums that are paid for deposit insurance on the one hand. And we also, of course, began making assessments not during crises, but between crises, just like, Joseph in the biblical story about the 7 fat years and the 7 lean years. We started making the assessments during the fat years so that the account would be topped off and, nice and full before crises happen. That was all good. It's a good thing that we did that. But what we don't seem to have noticed is that once we moved to a risk-based insurance premium system, as we did in 2005 by law, we rendered the $250,000 cap sort of irrelevant or sort of obsolete, because that was geared to a time before we did risk pricing of the insurance. And so at this point, it makes much more sense, I think, simply to eliminate the cap, to insure these deposits in full, but continue, of course, to risk price the insurance on the one hand, and also perhaps segment the accounts by size so that maybe there are fees assessed against the larger funds, the larger deposits that we're insuring, while continuing not to assess fees against smaller fry depositors like you or me, whose accounts both, I assume, are below 250,000.
A safe assumption. So, in other words, the bank did the right thing in terms of hedging, but not sufficiently, and it bought treasuries. But then Powell jacked up the interest rates, and the treasuries that they had yielded much more than the new treasuries, right? And
Exactly.
But in terms of deposits at this bank, above the 250,000 insured by the FDIC, Circle, which is a crypto operation, they had $3.3 billion on deposit. Roku, $487 million. BlockFi, $227 million. Roblox, these are all startups. Haven't heard half of them. Roblox, $150 million. Ginkgo Bio, $74 million. iRhythm, $55 million. Rocket Labs, $38 million. Sangano Therapeutics, $34 million. Lending Club, $21 million. And Payoneer, $20 million. So what happens to those people?
So they are all now protected, essentially owing to the announcement made yesterday, right, by Fed, Treasury, and FDIC. It's important to note that this is not a taxpayer bailout, at least not at this juncture, right? Because thanks to the risk-based regular premium assessment system that I mentioned before was put into place back in 2005, the Federal Deposit Insurance Fund, or what's sometimes called the DIF, the Deposit Insurance Fund, is massive. It's got multi-billions in it, right? So all of the payments, or all of the sort of payments to the depositors to make sure that they're kept whole, are going to be made out of two sources. One is all of those treasuries that SVB was already holding. Those are all being liquidated. And it's important to know that those were almost enough to cover all of the deposits, right? There was only the tiniest of shortfalls owing to the sudden devaluation of those treasuries thanks to Powell's crazy rate hikes. So that's going to be the primary source of essentially ensuring that those deposits are fully available. And then the little bit of overage that there will be beyond that will be coming out of the DIF, and it'll be just a drop in the bucket as far as its size relative to the size of the DIF is concerned. And again, all of that fund has been funded by premiums that we've been assessing against banks ever since 2005.
So going back to 2008 and before that, it's, I think, widely understood that the mistake was made during the Clinton administration of basically dismantling the Glass-Steagall Act, which came into place after the 29 crash and survived for many decades until Robert Rubin and Larry Summers urged Clinton to get rid of it. Then you had Greenspan at the Fed, and he's a disciple of Ayn Rand. It's just so interesting, isn't it? Whenever you have these bank crashes, the libertarians suddenly go silent.
Yes, don't hear a word from them now, do we?
Right.
Yeah. I mean, all of that was terribly wrong-headed, and all of that was part of the great financialization wave that sort of swept over the country over the course of the later 80s, 90s, and well into the 2000s. And of course, we saw the upshot in 2008. And of course, you'll recall that one of the things that people sort of called for after that happened was, they were saying it's time for banks to get boring again. And in a certain sense, ironically, SVB was precisely one of those sort of boring banks. Now, I know that the tech sector is not itself boring. And of course, it's always the case that any sector with lots of startups is going to see many more failures than successes. I mean, typically, for every iPhone or for every Tesla, there are probably a million Solyndras or whatever. But that's how that industry works. And it's better that banks be doing the financing, I think, than that shadow banks be doing it, or that derivatives markets be doing it, or that, Jamie Dimon, Jamie come to Papa Dimon and the JP Morgan Chase Bank or Wall Street be running all this stuff. You and I have talked quite a few times about the need to sort of reindustrialize the country and sort of lead the world on all of the green, eco-friendly technologies and industries of tomorrow. And if we're going to do that, my guess is that's a return to an industrially based economy. And that means we're going to have to return to a kind of institution that used to be more common as well, namely industrial banks. And so there are going to be a lot of sector-specific industrial banks. In effect, they're going to be industry-specific credit unions like SVB was, where these people are in effect lending to and borrowing from one another. But in order for all of that to work and for it not to sort of, fall apart and thus imperil the reindustrialization effort itself, we have to make sure that these things are safe. But we have a very straightforward way of doing that, I think. And that is simply to keep using the FDIC system that we sensibly modernized in 2005, but not modernize it just one step further. And that is, again, to ensure all accounts in full, but to segment the accounts so that we charge higher fees for the bigger accounts and no fees at all for the smaller accounts. But we continue to risk base the premiums that we charge, and we continue to impose the capital regulations that the FDIC always does as a part of its administration of the Deposit Insurance Fund.
So going back to Dodd-Frank, which followed 2008 crash and was meant to plug the loopholes, it was obviously a compromise. In fact, I remember talking to Barney Frank about it at the time. The banking lobby still was alive. And remember, it was the American taxpayer that bailed out Wall Street in 2008. And I think that turned out to be a catastrophic move on Obama's part. And it led to the Tea Party, which is now morphed into the Freedom Caucus. So they're not wrong being outraged, right? That Main Street gets hosed in order to revive Wall Street for their reckless successes. So you got this compromise known as Dodd-Frank, which requires banks to have stress tests, etc., and keep more money on deposit. And then along comes Donald Trump, and with Jay Powell among his advisors, and they, reduce the stress test for these regional banks and reduce the amount of money they have to hold on deposit. So there's, again, a direct cause and effect, isn't there?
I think it's possible that this had an effect, although it's a little less clear precisely what effect it actually had, at least in this particular case. Now, as you'll remember, you and I have talked before, I testified before House Financial Services back in 2015 and was also quite active in 2017 and 2018 to try to prevent any rollback or any sort of fallback away from Dodd-Frank, which, as you, I think, rightly noted, was already a compromise to begin with. So the idea of compromising it further was an exceedingly bad idea. And I think Katie Porter is right to want to sort of reinstate the regime that we had in place before the partial rollback in 2018. We have to do that anyway, it seems to me. That's just something that ought to be done, irrespective of what happens to SVB or its depositors. As to whether or not that itself was sort of key here, I think that's a little bit more in question, essentially for the following reason. There's been no suggestion at all that the portfolio itself of SVB was somehow improvidently formed or was improvidently put together or was somehow excessively risky or what have you. Again, the only thing that wasn't adequately hedged against was interest rate risk, which came so fast and so furious that very few institutions were probably fully hedged against that and fully, ready to deal with it. The only thing that would have been different under the previous regime is that the bank would have been large enough to fall under the requirement for so-called enhanced prudential regulation. But all that means then is that the regulators would have custom designed essentially a risk regulatory program for SVB. And whether or not they would have said, okay, look, we need more hedging against Fed interest rate risk here is hard to tell, right? Because again, so few people seem to have seen that coming that it's not altogether clear that the regulators would have described this at the time, before the last year or two as a serious risk.
So what is the situation now in terms of plugging the holes in the leaking dam? You've got Signature Bank in New York is also closed down on Sunday. I think a lot of British banks are having a hard time too. On CBS's Face the Nation on Sunday, Secretary of Treasury Janet Yellen said there were no taxpayers' money involved. Would you agree with that?
Oh, yeah. For the moment, that's true, right? Everything is coming out of the Deposit Insurance Fund, which, as I mentioned before, or I should say, all of the overage, everything that's not covered already by the loan book and by the Treasury's portfolio is coming out of the DIF. And because the overwhelmingly greater part is just coming out of the liquidated Treasury's portfolio, there's just a bit that's going to come out of the DIF for this. And there's plenty. There's much, much, much more in the DIF than what would be required for the present circumstance. That being said, I do have one concern, and it's basically this. The Fed has this way of being a bit too clever by half when it comes to innovating new quote-unquote facilities for various exigencies that come up from time to time. They're always acronyms, but they always end with the letter F for facility. And that was fine. That kind of creative facility construction on the fly in some ways was helpful in 2008, and in some ways was helpful in 2020, right at the beginning of the pandemic. But at the present context, I think it might be a little too clever by half in the sense that it's not entirely transparent to everybody exactly what the nature of this facility is and what its terms are going to be. And in some cases, complications or complexities like that are inevitable. But in the present case, they're not, because there's a very simple fix that could be communicated very clearly and simply to the entire public and thereby forestall any further possible bank run activity. And that is just the little tweaks to the FDI system that I mentioned before, just the extension to cover all deposits with continued risk pricing on the one hand and a sort of tiered structure of assessments according to size of deposit on the other hand. That would be simply conveyed, simply understandable, and it would remove all ambiguity, all uncertainty, and thereby remove all of the kinds of fears that sort of lead to continued runs on banks. I've written up a draft bill for this. It only takes a page. It's that simple that the draft bill only requires one page to elaborate. And as you can imagine, I've got some congressman friends who are going to be introducing that in Congress. So I'm hoping that Congress can act quickly to pass something like this, just quickly update, modernize, complete the job of 2005 to the federal deposit insurance system. And then I think we'll be golden as far as the present problems are concerned.
So just in closing, you don't see a run. This is not Jimmy Stewart in It's a Wonderful Life.
I think there is a danger of continued running if we don't do precisely what I've just been suggesting, right? I think because there's still some ambiguity and some uncertainty about the precise terms of and the precise applicability of this new quote unquote facility that they announced yesterday. So I think if we really want to make sure that no further running happens, I think we have to do the thing that I've just proposed.
Well, Robert Hockett, I thank you very much for joining us here today.
Such a pleasure always, Ian. Thanks so much, my friend.
And again, I've been speaking with Robert Hockett, who has had first-hand experience working at the International Monetary Fund and the Federal Reserve Bank of New York and continues to consult to a number of U.S. federal, state, and local legislatures and regulators. He drafted Representative Alexandria Ocasio-Cortez's Green New Deal resolution for the House of Representatives and officially advises her on economic policy. He's the Edward Cornell Professor of Law and Professor of Public Policy at Cornell University. His latest books are Money from Nothing, or Why We Should Stop Worrying About Debt and Learn to Love the Federal Reserve, Financing the Green New Deal, A Plan of Action and Renewal, and The Citizens Ledger, Digitizing Our Money, Democratizing Our Finance. And he has an article at Forbes, What Then to Do Going Forward? How do we keep banks like SVB rather than handing them over to the Wall Street Big Five while also avoiding debacles like that of last